How does trading in my old car affect my used car loan? Have you ever wondered how trading in your old car impacts your next used car loan? It can actually make a big difference in your financial situation. Let's break it down. When you trade in a vehicle that still has an outstanding loan, the concept of equity comes into play. Equity is simply the difference between what your car is worth and what you still owe on it. If your car has positive equity, that means it is worth more than your remaining loan balance. This is great news. The trade-in value can be used as a credit toward your next vehicle purchase. This credit can lower the amount you need to finance on your new loan. As a result, you may enjoy lower monthly payments and pay less interest over time. On the flip side, if you have negative equity, this means you owe more on your loan than your car is worth. In this situation, you will need to address the difference. You have a few options here. You can pay the difference out of pocket, roll the negative equity into your new loan, or negotiate alternative arrangements. Rolling negative equity into your new loan can increase the total amount you are financing. This often leads to higher monthly payments and more interest paid over the life of the loan. It can even put you in a position where you start your new loan already in a negative equity situation. Lenders, including banks and credit unions, carefully evaluate this risk when considering your loan application. When you trade in a car with an existing loan, the loan term length and loan amount for your new used car loan can be affected. If you roll over negative equity, the new loan amount will be higher. This may require extending the loan term or increasing your monthly payments to keep them manageable. Lenders will look at your creditworthiness and debt-to-income ratio to determine what loan terms they can offer you. It's also important to note that dealers often provide wholesale trade-in values, which can be lower than what you might get if you sold the car privately. Factors like high mileage or wear can affect the trade-in offer. To avoid surprises, it's wise to research your car's value before heading to the dealership. Before you trade in a financed vehicle, consider these steps. First, calculate your car's current value using trusted pricing guides. Next, compare that value to your remaining loan balance to see where you stand with equity. Think about whether rolling over negative equity fits into your budget. You might also want to consider trading for a less expensive vehicle to minimize your new loan amount and interest costs. Finally, remember that trading in a car with a loan does not automatically pay off your old loan. The dealer typically pays it off on your behalf, but you remains responsible for any balance that is left. In summary, trading in your old car can significantly affect your used car loan. Positive equity can lower your new loan amount, while negative equity may increase it and lead to higher costs. Understanding these factors can help you make informed decisions when financing your next vehicle.